Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Welcome to another episode of the Real Estate Investor Podcast. Joining me today are Joe Fang and Andy Huang from the Break of Day Capital team. This is episode 250. I can't believe it. So most of you already know this, but those that don't, I started this podcast in spring of 2020 with another person, and it was called the Real Estate Asset Management Podcast. Guests would come on typically for no more than 10 minutes, and we discuss one aspect of asset management, something that just wasn't talked about then and only sometimes gets talked about now. I was and still am deeply passionate about asset management. It's where the rubber meets the road. Good asset management can make such a huge difference on a property. It can make a bad deal good and a good deal great. Some of our first guests were Brian Burke and Maureen Miles. We had a tax strategist, Brandon Hall, on a couple times. And on the legal side of things, Merrill Callister and Mauricio Raoul. And I learned so much from our guests. Most investors rely on gut feelings, shiny brochures, or hype. And that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. On episode 68, it was just me from then on, and I eventually changed the name of the show to the Real Estate Investor Podcast so that we can be more broad about our topics and not just discuss multifamily real estate. We've had world-renowned economist Peter Linneman on a number of times. We've had lenders. We've talked about optimal health and mindset. We've had athletes on, including former NFL player Larry English, multifamily marketing experts, a firefighter. We've had veterans on. Sahil Bloom talked about the 5 types of wealth. We've had well-known LP investors like Jeremy Roll, Chad Ackerman, and Alexei Chenabelsky. Sorry, hard name to pronounce. You name any type of real estate, and we've probably covered it. Everyone has a different story. This is very rarely the same path for someone, and so many different ways to make money in real estate. We discussed many wins and struggles along the way, and those that have perseverance are the ones that survive and thrive in this business, like any business. And those that just came in for a quick buck didn't make it. Andy, how about you? What do you have a favorite episode or takeaway?
Yeah, my favorite episode this year, I mean, it might be pretty appropriate for the time we're in, but it was the AI episode with Neil Bawa. It was about how you can use AI to help you sort of narrow what type of area you're going to look at or the type of deals you're looking at. And you know, it just opened my eyes and I hope our team's eyes into how powerful AI can be and the various aspects in which it helps our jobs. So even though that was on the asset management side and I work on the investor relations side, there were still takeaways for me of sort of realizing the power of AI. And, for me personally, if you go back 2 years ago when ChatGPT first came out, I didn't really use it much because I didn't think it was very, relevant to what I was doing for work and my personal life. But nowadays, you fast forward 2 years, and almost everything that I think I'm curious about in my mind, I can run into ChatGPT. So just a huge difference in how I personally think now. And I think that episode helped me realize, in our company, of all the various avenues that we could use AI technology as well, and we have been doing that.
Joe, how about you?
Yeah, well, First, Gary, I just want to congratulate you on reaching recording the 250th episode. I still remember the time that you and I discussed internally whether we should keep the podcast going after 2 to 3 years, because a lot of people don't know this, but it's a lot of work, and having to interview lots of different people and scheduling and etc. But I felt that not only did it provide a lot of value, but we thought that it would be better to maybe evolve it to covering more topics, kind of a broader stroke, things that a lot of people would be interested in. And as you mentioned earlier in the intro, it started off being very niche. It's almost more geared towards industry specific operators like ourselves in asset management. Then you started covering different real estate food groups, some obscure ones, like parking lots or parking structures. I think you did that one with yeah. And then even lifestyle and mindset stuff. I think you had Ryan on before, and it just those things are all very important and kind of encompasses most things that people are interested in. And so to commemorate the 250th episode, I want to go full circle and get back to the roots of this podcast, which is asset management. And so, with that, I'm going to say my favorite episode so far this year would be the one where you did interviewing Tim Chu, who is our asset manager. If you haven't heard it, I definitely recommend you checking it out. He really goes in and talks about the skills that are required to be a good asset manager. And those are things like being good with analyzing data, knowing how to, work around the spreadsheet. But not only that, though, also having hands-on skills, because he's got to deal with, different levels of property management, contractors, people in construction, and they all have different personalities, so it's kind of like you got to be a really good desk jockey, but you also have to be a really good hands-on, in on site, type of person. And also, he also talked a lot about some great value add ideas, and that kind of goes to show you like the things that we do to make improvements to the property and ultimately deliver value to our tenants and to our investors.
Yeah, that's a great episode, and Tim's done a tremendous job for us on the asset management side. It was great to hand him the keys and let him run with it to free me up, and I learned from him his analysis and how he looks at things, and um, yeah, it was great. It was great to interview him to share his knowledge. So. This is our last podcast of the year, probably. So I wanted to get listeners up to date on the latest macroeconomics. Joe, what are you seeing?
Well, before we kind of give you just some snippets of our outlook for 2026, we won't get too deep into it. Maybe we'll save that for our semi-annual um, uh, webinar down the road. But let me start by just kind of giving you like a 2 minute summary of what we've experienced in 2025. Let's say that it's been a very wonky year. There's been a ton of volatility, to say the least. It's just, when you know, people who voted for Trump really thought that he was very pro-business and pro-growth, but with the whole tariffs thing, and there are some jawboning between the administration and the Fed. There's it actually ended up introducing a lot of uncertainty. You talk to business managers in different sectors, and a lot of them just say they don't know how to forecast because they don't know how the tariffs are going to impact the businesses. And so that's one big area of unknown that we had to deal with. And then if you guys remember, earlier in the year, there was a lot of talks about Doge, the Department of Government Efficiency. We were going to try to have some austerity, with government spending. But as we all know now, that was met with a lot of opposition. And so, to pivot, now, our Treasury Secretary Scott Bessent is saying, well, it doesn't seem like we can really, cut expenses much. We're going to have to grow our way out of this, meaning that they're going to have to do everything possible to stimulate the economy, so that we can grow GDP in excess of the government debt, so that, it looks more manageable. And so, with all that said, it seems like, we might be at the start of a regime change, meaning that, we've the Fed has officially ended quantitative tightening in December, and then, as of today, there's a 100% probability of 25 bips cut this week. And that's kind of where we are. The CPI has been a little sticky, but it's kind of in that, mid to high two. So it doesn't seem to be threatening to go higher. So that gives the Fed a lot of room to to cut, I guess. Yeah.
All right, thanks, Joe. Really informative. Yeah, so many people forget Doge was such a big thing, and boy, it's like the furthest thing from people's mind these days because of tariffs and other things. It's crazy that it's all been in the last year.
Yeah.
Andy,
Yeah.
oh, go ahead. Sorry.
Yeah, and then, if I can just maybe spend a couple minutes, just kind of expanding a little bit more on our 2026 outlook. As I mentioned, Besant wants to grow our GDP out of our way out of the debt problem. And so he has said, he's expecting the next 3 quarters to experience accelerated growth. And we have the U.S. Treasury, has $38 trillion in debt, and about 10 trillion of it is maturing, in 2026. So, they're gonna have to try to figure out how to make this work. We know that lenders are not willing to lend our government long-term debt, just because, we do have to print our way out of this. We do have to debase our currency. And so, lenders are saying, well, I don't want to be married to you for 30 years, but, I'll lend you 1 or 2 years at a time. So that's kind of what's going on right now, or what's starting to happen. Um, as far as like, the first half of 2026, we expect the monetary and fiscal policies to be pretty accommodating. And these are just some of the developments that we can share with you. So there's something called the enhanced supplemental ratio exemption, which is basically, has to do with how much banks have to keep on their reserves, so that, when they make loans, they have to keep a certain amount in equity, right? And so with this ELSR exemption, they're able to buy U.S. Treasuries, which basically helps finance the government without taking a hit to their reserve requirement. What that means is that it frees up a lot of capital to lend to, people like us, real estate operators, and even your regular homeowner. So that should, bring some liquidity back into the system. And then, with that, we expect rates to drop, not to 2%, but maybe in the high fives, mid fives for mortgages. And then Trump's talked about, handing out, $2,000 STEMI checks, from the tariffs. And that, if we do get that, that's going to be quite stimulatory. And then finally, some of you who are paying attention to uh, developments with the Fed, it appears to be that Kevin Hassett might be our next Fed chair to replace Jerome Powell, and he's known as a dove, so he's a supply side economist, and he really believes in uh, a loose, monetary policy to stimulate the economy. So that's kind of pretty much, what we're expecting for at least the first half of 2026.
Yeah, hopefully it isn't as wild of a ride next year and more of a smooth sailing heading into low inflation, good growth, and great for apartment building buying.
Yeah, absolutely. We definitely could use a relief. I mean, it's been hard for the last 3 years with rates so elevated and quantitative tightening finally ending.
Yeah, yeah. And investors, I think, just kind of nervous about where to put their money um, and it's been a lot of dry powder sitting on the sidelines for real estate, but I mean now is really really a tremendous time to buy. While interest rates are still reasonable and coming down, yet you're buying it at such a discount, a 30% discount from the high of 2022.
Yeah, absolutely.
Andy, I know recently we walked away from a deal that we just put under contract, and we've only had three deals in the last 3 years. But as anyone, how hard it is to get a deal under contract. Talk to me a little bit about that in the process.
Yeah. So, I mean, before we talk about the specific Tucson deal that we recently walked away from, I think it's worth sharing how we think about walking away from a property in general. So, as you just mentioned, getting a property under contract is very difficult. Also, as you just mentioned, we've only done three deals in the last 3 years, but that hasn't been without trying. So, I would say in the last few months, we've probably come close 3 or 4 times. In the best and final, we were probably the highest bid in a couple of them, including the Tucson deal. So, it hasn't been without trying. It's just been really difficult. So, but we try to keep in mind is that closing the wrong deal can hurt investors for years. So we try to be really careful about what deals we commit to. And so that's why we do due diligence. So you test everything you can't see in the broker package, from the roofs, the plumbing, electrical panels, how the property is able to get insured, especially in today's insurance environment. So if the risk profile changes, then we have to stop and reassess the property itself and see if the properties the deal is worth pursuing. So a good operator is defined just as much by the deals that we refuse and the versus the ones that we close. So that's just as important. So for the Tucson deal, Gary, Tim, and I about a month ago went to go do some due diligence and walk the property on a deal we were going to buy. And so everything looked great at first glance. The curb appeal was good. The occupancy was good. Nothing from the street told us to be worried. We even did drive-bys at night. Nothing seemed out of the ordinary, so it looked good. But once we did the actual walkthrough, the story kind of changed. So some of the things that we found out was the roof was in much worse condition than we expected. We had two different spots where the roof almost gave away when we were walking the properties, which tells you there's deeper structural deterioration than just normal wear and tear, which could mean deeper problems down the road. So then after that, we checked the electrical and found out the panels are outdated, placed behind washer dry units, which alone are safety issues. So as I mentioned before, what we have to really take into account these days is their ability to get insurance. And so if we were to buy a property with electrical issues and safety issues like this, it would be really difficult to get insurance, or it'd be really expensive to get insurance. So so doing the walkthrough, we realized that a lot of the existing work looked cosmetic versus true fixes, which means that we'd be dealing with these problems for years. And so, usually when this happens, and maybe not to this degree, but we'll go back to the seller and then renegotiate. So in this instance, the seller was willing to patch up a few items, but the patching doesn't really, address the underlying conditions, because if we were to buy this property, we're pretty much inheriting the risk and the issues, and then it's going to be the exact same issues when we go around and sell it in 3 to 5 years to the future buyer. So these are when we look at deals, we're not only looking at what the condition is when we're buying it, but we're also thinking about an exit at the same time. So at this point, when we realize all these issues, the deal wasn't the deal that we underwrote in the beginning. So the cost became much higher. The risk exposure is real. The potential issues of getting insurance was real. So we had to walk away from the deal. Walking away is never fun, especially when they get a property under contract in this environment. But I think protecting investor capital and being more conservative about these decisions is what's best for our investors. So, when to summarize, if the facts change during due diligence, then we have to stop and reassess and look at the deal from a new lens. And in this case, it just didn't. The numbers didn't work, and we just simply walked away and hope to find another deal soon, which hopefully we're on the path of doing. But just doing going through these types of due diligence, which takes a lot of time and money. As I mentioned, we flew out there. Tim's been doing a lot of work. But when we walk away from deals like this, it gives us more confidence in the deals that we end up doing. And so when I talk to investors, I always try to remind them that even though we're not always actively buying deals, we are trying. And even though they're not turning into actual transactions, we're getting a lot of market intelligence from it. So it might not turn into an actual transaction now, but it's just feeding our information and the data that we have to be able to make better offers and more informed offers going forward. So, as Joe was saying, the market might be shifting coming up with rates changing and hopefully lowering. So I think it's just a good way. This was a good exercise to help us sort of remind us of our discipline when looking for new deals.
Yeah, painful, but yes. Um, but yeah, it's yeah. At the end of the day, we have to protect our investors. We're in this for the long game, like you said. Um, and yeah, it's a lot of time and money. Even the deals that we don't even get to contract, we're it's a lot of work, but it sets us up for success having all those data points and all that information so that we know if a good deal is good or a bad deal based on all of the data that we accrue. So yeah, like exactly what you said.
Yeah.
Anything else you guys want to say before we wrap up this 250th episode?
Yeah, I'm just saying, it's been a rough environment, and we always talk about hopefully rates will fall, and we indeed hope so. But at the same time, we still have 9 active deals going on. So even though we're not constantly buying, entering into new opportunities, we still have 9 deals that we've been entrusted with our investors to, make sure they have a positive outcome. So, our eyes still on the ball. We're still looking for new opportunities, but on a day-to-day basis, we're still ensuring that our investors' assets are well protected. And so we're on a day-to-day basis, that's what we're doing, and just reminding everybody of that.
Yep, yep, absolutely. And it's a lot of work managing those properties and battling through price sensitivity, concessions, delinquency, a lack of rent growth. But yeah, we keep pushing away because the tide is starting to turn, and that's when the good operators make a huge difference.
Yeah, Gary and Andy, I would say that, looking out to 2026, as both of you mentioned, this is 2026 is a year of transition, where uh, you have an administration, that, for lack of a better word, has to deal with midterm elections. And so, they're going to do everything possible to make the markets pump, and make sure people are happy. And one of the ways to get, Main Street happy is to get rates lower so that you'll have more transaction volume in real estate. And because, like it or not, that's the bulk of most American citizens have the bulk of their net worth in their homes, and so once you get those kind of things, turning again, there'll be a lot more liquidity and the risk appetite will increase again. And and at the same time, we're seeing better deals out there. There's properties that were, some of the last few properties that we're looking at, and the ones that we're looking at now, um, they can be had at below replacement cost, which is it's pretty amazing. And I hope our investors will, join us this year and trying to pick off some assets, at discounted prices that we predicted a couple years ago. So it's all coming, this is all we're going to be able to get these, so I hope our investors will take advantage.
Yep. For our listeners out there, I can't promise you I'm going to be doing another 250 episodes 6, 7 years from now, but I can promise you we'll be doing a steady 30 a year, bringing on guests that I think you and I can learn from and that have a unique story. It's been an honor to serve you. And if you've gotten value from this podcast, I have an ask. Please like, subscribe, and leave a review so that others can get the same value you get out of this podcast. I know your time is valuable, and I appreciate you spending some time with me, Joe, and Andy today. Be well, and I will see you on the next Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.